Market sell-offs are never a fun time. The economy struggles, people lose jobs, doom and gloom floods the news, and portfolios are down everywhere. But what if there is a silver lining? Hey everyone, my name is Arjun and welcome back to the channel where we talk about all things investing. Most of you know that 2022 has not been a kind year to the stock market. All the major indices are down double digits for the year. That's why this is a great time to talk about a technique to cleverly profit from this downturn called tax loss harvesting. It's the process of writing off investment losses to reduce your tax bill. These losses offset capital gains from other investments and or reduce your income up to $3,000 per year. Anything over this amount can be carried forward to future years. Just note that you can only tax loss harvest inside a regular taxable brokerage. So this would be your Robinhoods and Weebles of the world. It is not possible in a retirement account like a 401k or an IRA because there's no tax implications when trading inside these. To me, an example makes it a lot easier to understand. Let's say that you bought $5,000 worth of Pied Piper shares. Richard Hendricks promised the world, but then failed to deliver, leaving your shares to be worth only $1,000. You decide you've had enough and sell for a $4,000 loss. Let's say that you also had $1,000 of gains from selling other investments. $1,000 from the loss offsets those gains to zero, and the remaining $3,000 reduces your taxable income. Depending on your tax bracket, that might save you up to $1,100 in taxes at the federal level alone. In today's times, that just might be enough for a full tank of gas. Turning investment losses into tax breaks may sound good on the surface, but deeper down, there is a problem. Losses occur when your investment goes down in value, which is usually not a great time to sell. Unless there's something fundamentally wrong, a smart investor knows that the market will rebound over time. Selling for tax reasons alone is usually a losing proposition. But is there a way to get the best of both worlds? Well, the answer is to tax loss harvest your losing investment into a comparable but not identical one. You'll see why I use these exact terms later on. This way, you're still fully invested, so you haven't technically sold low, and yet you can still take advantage of these losses on your taxes. Since I talk a lot about index funds on this channel, let's use that as an example. Let's say in January, you purchased $5,000 of my favorite index fund, the Vanguard Total Market ETF, VTI. Because 2022 has been rough so far, let's assume it's only worth $4,000 today. You have trust in this investment long term, but still want to take advantage of this downturn. So you sell all of your VTI and use the money to buy a similar investment like the S&P 500 ETF, VOO. These two are similar in that they have a correlation of 0.99, but are different enough to prevent a wash sale, which I'll talk about later. You're still left with the same $4,000, just in a different ETF that will perform almost identical to VTI. When you do your taxes, you get a tax break on the $1,000 loss on your initial investment. The net effect is that your portfolio remains almost entirely the same, yet you get to save on taxes. The best part about this technique is that it doesn't matter how low the market goes. You can just keep rotating between these two funds all the way down and getting tax breaks along the way. All this talk about an upcoming recession really doesn't make much of a difference. So to sum it up, First, something causes a loss in portfolio value. Next, you lock in your losses by selling. Then, repurchase something that's similar but not identical. And finally, claim those losses to save thousands in taxes. This is how you smartly tax loss harvest. That being said, there are a few things that you should watch out for. The one that I brought up earlier is called the wash sale rule. This states that you can't just rebuy the same investment within 30 days of selling. You also can't buy in the 30 days before you sell, unless you sell all of the shares that you just bought. If you do violate this, then the basis gets reset and you get no tax breaks. You may not be able to buy back the same investment, but you can buy something that is comparable. So in my example, we swapped out the total market ETF for an S&P 500 ETF, which is okay because they track different indices. But selling the total market ETF for a total market mutual fund like VTSAX would have violated the rule because they're almost exactly identical. You have to be careful with this because IRS themselves don't have clear definitions of this. So I'm going to put up a list here of vetted substitutes for popular funds in case anyone wants to screenshot. Also, make sure to track dividends because this can sometimes trip people up. Automatic dividend reinvestment plans can trigger wash sales accidentally if you're not careful. Remember also that all of these rules apply across accounts. You can't trick the IRS by selling in your taxable only to rebuy in an IRA, for example. Now, some people might say, sure, you're saving on taxes now, but you will just have to pay it all back when your investment goes up and you eventually sell. Sure, this is kind of true, but there are some reasons why you'd want to consider doing it anyway. Number one is tax arbitrage. You reduce your income at your marginal tax rate, which can be as high as 37%, but you only have to pay back at your capital gains rate later at 15%. The second is that inflation becomes your friend in this case. The money you get back now is worth more than the taxes you pay in the future. The higher your income and investments are, the more valuable tax loss harvesting becomes. However, tracking all of the different accounts, dividends, and wash sales does require some legwork. So personally, I would not consider doing this if I only end up saving small amounts. There has to be enough ROI for the time I'm spending. So if you have some underachievers in your portfolio this year, do give tax loss harvesting some consideration. It just might make the pain slightly more bearable. But I did list out some cons as well, so make sure to only employ this strategy if it makes sense for your own personal situation. That's all I had for today. Thank you so much for watching. I'll see you in the next one. Later.